for the most part, everybody was really on it this week. So that's good. There were one or two who totally didn't do what they were supposed to and knocked everything out minutes at a time and spent 2 minutes on the quiz and got 2 of them right, and then redid it, and 3 minutes later had all of them right. And that is completely unacceptable in here. That's ridiculous. All right, so don't do that. That person probably will not do this recording anyway. So I don't know. I don't know the person. So we'll see. We'll see what the situation is with that. But he's definitely gotten my attention with that. So don't do it that way. Put the time in. We're master's level. It's time to get to work on this stuff. We can't be acting like we're freshmen or sophomores or anything like that. Not that any of y'all will do stuff like that necessarily when you were freshmen or sophomores, but we hopefully have gotten to the point where we do master's level work at the master's level. So, but yeah, I mean, for the most part, everybody was pretty well on top of it. There were a few who didn't quite get everything finished. Maybe they can finish it up this week and get back on track. But, with those weekly assignments, there are almost 70 people in this class. And a lot of the little rules that I have for doing things may seem a little strict, but it's really for the purpose of me remaining sane, right? Because I don't want to make judgment calls about somebody's assignment each week about, oh no, this happened, can I get an extension? That's a long email to write. I had an email I had to answer this week, somebody asking for an extension. It took me 30 minutes to write it because I'm like, how do I do this without sounding like a jerk? How do I do this and still sound nice and get it done the way I want? So, multiply that by 65, and that's a lot of time. Not that 65 people will get an extension every week, but you'd be surprised. So, and then, the all or nothing on each week, it just keeps the time. It's hard to go in there and say, okay, they did 7 of these, 7 divided by this is this. That's too much. So just do it all and get it right and get grade, or don't do it all and get no grade. It just makes it easier. And, these weekly things are worth like a 1.33 points on the final grade anyway. So hopefully you wouldn't do less than, miss more than one of those anyway. But anyway, I'm not a strict jerky guy or anything. It's just, I don't want to go crazy. That's pretty much it. So there you go. So hopefully when we're out of here, we'll be ready for the audit section of the CPA exam. So we have officially started studying for it, and y'all find it fairly easy. Boring, but easy. I find audit to be by far the easiest of the 4 sections. That's my opinion. I took it first. I made my highest grade on it. I don't know. It just seems the easiest. Now the pass rates don't really agree with me, but I still feel like audit's very easy, very doable exam part. And we'll have a chance to go through and kind of talk through some of these things. My role will be I'm taking a lot of these certification tests. I got a good feel for the types of things they do and don't ask. A lot of what I'll say, it'll be opinions. I think this would not be a test question. This will, I'm bound to be wrong at some point on those, so I'll go ahead and put that out there, and I'll probably say it over and over again. But there's one of these is going to be me saying, you won't get a test question on that on the CPA exam. And sure enough, somebody will. It's going to happen. So just keep that in mind. These are my opinions on what to focus on and what to maybe focus less on. You'll hear a lot of that this semester. That's a test question. Know this. That, probably not a test question. That kind of thing. Okay. The way I study, this is a good time, if you haven't already, is a good time to develop a good systematic way of studying. That's kind of what it takes to get the CPA exam knocked out. Very systematic, very organized. Don't get rushed to where you get out of your system that you like and get unorganized, right? So leave yourself enough time to each week spend adequate time on this, right? Not the 2 and 3 minutes per section that 1 or 2 people did. That is just going to waste the time that you took to randomly key in answers and then get the right answers. And then you actually haven't done anything. So then you got to go back and do it sometime anyway. But yeah, stay on top of it. Develop your own way of studying that works for you. Here's what I do and what I've always done. And the things I'm presenting to you, this is as if I was studying for this, right? I read each section and I take my notes on a Word document. That's what I've always done. These are the notes I would have taken if I was studying for this audit exam. This is what I would have done. I read the section once. I jot down the things I think I want to look at again. And I never look at the book again or the software again as far as the text goes. I have everything that I think I need to remember here. Right? So once I've read the book, I've got pages of notes. And that's now all I'm looking at as I'm studying. As I'm getting close to test time, I'll print these out, highlighter, and I start looking through there, and I cross out with a I kind of use a highlighter to strike it from the record to cross it out. I cross out everything that I know, right? As I'm reading through, oh yeah, I know that. Oh yeah, I know that. Yep, I'm good with that. Then I'm left with, okay, everything that's not highlighted, that's what I don't know yet. So that's what I'm focusing on. I might even transfer those to index cards if it helps me, right? And that's a good thing to do anywhere along the way, which I always do that too. And I'll do the same highlighty thing with those, but I'll stick those in my pocket. And if I'm walking around or if I got 5 minutes to kill, I'm pulling those out of my pocket. And I'm studying without realizing I'm studying. It's not wearing me out, right? So as I'm getting closer and closer to test time, I'll see everything highlighted out. That means I know it. I'm good. That's the way I've always studied. Very systematic, very organized, overwhelmed. And I carry those cards everywhere. And you'd be amazed at just second here, second there, how quickly I already know this. Right? Another thing I've picked up over the years, I wish I had done this sooner in my life. Of course, I like paper copies of stuff. So when I say this, I actually do have a paper copy doing this, but it would work for your screen too. I keep that thing on the kitchen table, open to where I need it. If I'm walking by, I'm like, all right, I'm going to sit down and do a page. Wasn't really on my mind, but I saw the book. I'm like, let me knock out a page. And then a page turns into 2 to 3 to 4, and then suddenly, without even making myself study and work, I've knocked out 10 pages just because I got in a good rhythm. It's amazing. I still do that when I'm doing any kind of work. And I have this just grab as you go type thing. And it really, really helps. And it really, really spreads it out. It really, really accomplishes a lot of work without really realizing you're doing any work. I do that in other things in life. If I'm emptying the dishwasher, I don't just sit there and empty the whole thing. I'll grab a glass or two, stick it in. Later in the day, walk by, do a few more, grab a handful. Then it's done. You really sit there killing. I won't take long to empty the dishwasher, but just kind of grab as you go. It works really well. That's my method of doing all this. What you don't want to do is wait until January 12th when it's due and start looking at it for the first time. You're not going to retain any of it. You want to skip a lot of stuff. And you may not go back and look at it ever again, and you're lost on that section, right? So that's really important. Stay on top of it. Very, very important. Okay. All right, then. So what you have here are the notes that I would have taken if I was studying. And I will have those posted on Canvas for you if you want them. If you don't, I'll look at them. It's fine. Don't just use these as your study guide, though, because one of the, you really need to do your own, right? Because as I'm typing these out, I'm learning it probably better than, I've already got most of it figured out as I'm typing it. So don't study somebody else's notes. At least I wouldn't be able to do that. I have to make my own, organize it the way I like, put the things in there I want. The more you look at it, the better. The more you organize it, the better. All right. Okay, so these little chapters are nice little tidbits. It makes it nice and easy to grab as you go. Like I was saying, it's like, well, let me knock out a section. It's 2 pages. Why not? Easy. Do that throughout the week, and you'll have it done in no time. Okay, so let's get moving. We have our first section, and this is the AICPA Code of Professional Conduct. The good thing about audit, you're not number crunching, you're not filling out stuff with your calculators and stuff like that. It's a whole bunch of conceptual things. There's lots of memorization here, and we tend to be pretty good at memorizing stuff. There's some judgment calls too, but a lot of memorization in audit. So the Code of Professional Conduct. So this is going to cover any service that any member of the AICPA performs. So we're mostly in here, or really anywhere with this. We're mostly talking about members in public practice. But members who are not in public practice are also covered by sections of the code as well. So members of the AICPA have to follow this code. Public practice, members in business, and other members. An other member would be somebody who's not employed or maybe is retired. That's pretty much what those are. Members in public practice, you know what that is, or you will in a minute when we talk about it. Members in business, that's pretty self-explanatory. This is something I added to my notes after I did the multiple choice questions for this section. So keep that in mind as you're going through this semester. This is all study material. Those multiple choice questions, the more of those you can do, the better. That is the best way to prepare for the CPA exam, is to do as many example questions as possible. Anyway, well, let me just say it without showing you. On most of the modules, not all of them, but most of them, and I would probably save this for last just to make sure you don't get behind. But on most of the modules, if you scroll all the way down, unless they've changed the format on it from y'all's point of view, there is a link at the bottom right of most of the modules that says Test Bank. You click on that, it's got a whole bunch more multiple choice examples. Those assessments that we do for, the completion grade, there's usually 3 to 10 of those. Those test banks, they'll have more in there, different, of course. Some of those have 30 or 40. I've seen some of them may have 1, but practice as many as you can. Now, we also add that this is a deal where the questions they're using, a lot of these are past CPA questions, but some of them are things that authors of the book have written. And those aren't always great. Some of those will maybe be a little fuzzy. On the actual CPA exam, there's no fuzzy questions. So don't get frustrated if some of these questions are a little vague. Just realize, okay, that's a wily author who wrote that, and it didn't go through the rigorous reviews that the actual CPA exam questions do. So we'll come across some of those along the way for sure. All right, so enough of that. So we talked about just this top little part here, but yeah, the thing I picked up from the multiple choice questions that I added in my notes are, if you fall into multiple areas, you may be a member in public practice and a member in business, you are to choose the most restrictive of those. And you would be able to reason through something like that anyway, right? You're a member in public practice, you're not going to abide by the less strict members in business rules, right? But I guess if anything we're learning here that we may not have been explicitly told is members in public practice code language is more restrictive than the member in business one. So there you go. All right, so we got 6 principles of, and we're still talking about the code here, of professional conduct that are in this code. Would you want to memorize those? No. I mean, you're not going to have a question that says list the 6 principles of professional conduct, right? So you got to get in the test maker's head a little bit. Something about that. But no, I wouldn't memorize these 6 things. I mean, you can, but like I said, you're not going to get a question that says what are the 6 principles of professional conduct. You may be about each of these things. And these tend to be the questions you love because you can reason through this. This is everyday words right here, right? We know what objectivity means. We know what integrity means. We know what independence means. So you can kind of rely on just everyday knowledge to get through questions sometimes. Now, I don't know necessarily for this topic, but you do sometimes see questions that might be like, which of the following is not one of the 6 principles of professional conduct? And you love those too, because it's like, well, obviously this one isn't, because that's stupid, right? So those are easy type questions. So no, I wouldn't devote any time to just being able to, all right, let me see if I can list the 6 in my head. That's wasted effort, in my opinion. Just be able to talk about them, to be able to recognize what this stuff means. This is pretty easy content, right? So those principles are responsibilities, which is kind of a vague title for it, but basically it's pretty broad. In carrying out your responsibility, you should exercise professional and moral judgments in a good way, right? I can't see any test question about that. It's too vague. It's too broad. So I would probably not worry about that. Public interest, act in a way that serves the public interest. That's really big with us, right? As accountants, especially auditors. That's what we do, right? The big mark of our profession is we have this responsibility to the public. Can't really see a good test question with that though, right? These others maybe, integrity, objectivity, all that. We know what integrity is. So what is right, what is just. Objectivity and independence. Those are the hotter topics here that tend to show up in test questions at the end, because they're such, they're covered in such detail in other sections of the book. But objectivity is just being objective, right? Being free of conflicts of interest. Independence is being independent, not only in fact, in reality, right? But also just in appearance. You may be independent, but you want to make sure that you're not doing anything that would make it appear that you're not. So that's an important little phrase that you'll see a lot. Independent in fact and in appearance. Very important. These things I highlight green are just things along the way that I say, yeah, this is important. So we'll talk independence to death. Y'all will be so sick of talking about independence. And that comes later. But to keep in mind, only members in public practice have to act with independence. Members performing all services would act with objectivity and integrity. And you would know that, right? You're not going to say, oh, members in business have to be objective. Of course they do. They have to act with integrity. Of course they do. But they don't have to be independent. They are working for a business. Not going to be independent of the business. But anybody doing attest services, audits, reviews, that kind of thing, we are attesting, like an audit is a type of attest service. We got somebody's financial statements that they've made, And then we've got the public who wants to rely on that. And we're the ones doing all these tests to say, okay, this appears to be presented fairly in accordance with the act. If we're not independent of the company, nobody's going to believe what we say. You know, like, hey, my buddy's financial statements are good. You're fine. Go, yeah, sure. Okay. No, we have to be independent. Due care is a word you hear a lot. And it's just kind of self-explanatory. You have to exercise due care when you're carrying out your duties. What it does not mean is that you have to be perfect. And believe it or not, that shows up in test questions all the time. It's usually a throwaway answer where it says, we got to get everything 100%, or we have to test 100% of these transactions to make sure it's absolutely perfect, that kind of thing. It's always a throwaway answer where they're wanting you to do 100% perfection. Those are always good throwaways. Perfection is not required. What we need to do is keep learning, keep up with standards. To be competent, we don't have to know off the top of our head all the answers. We just have to know how to research and find the answers. Due care, another thing that would fit into that category is just adequate planning and supervision of engagements, and of course the carrying out of those engagements. And then this last one, scope and nature of services, kind of vague in the book, but they're touching on things like having a good quality control, internal quality control, which we'll talk about later too. Exercising good judgment on whether our services would be, figure out the words I'm trying to say, whether we would create like a conflict of interest, or whether we, that kind of, it's really vague, but yeah, it's like having good internal quality control procedures, exercising good judgment about the services being provided, not getting into areas where you shouldn't be providing those services, that kind of thing. And then they throw this random definition that probably will not make any difference to anybody at any point about a partner equivalent, but I stuck it on there. So partner equivalent is not an actual partner, but has ultimate responsibility for the engagement or has authority to bind the firm without partner approval. So it makes it into the category of partner. Not worth having there, but sometimes I stick stuff on there anyway. All right, so not a whole lot of heavy stuff here. It's really setting the stage. It's an introductory section. I feel like any question you get from this, you'd probably be fine. There are 4 questions in the assessment questions that y'all had to do. Again, some of these are good, some of them are great, some of them are not as great, but all of them are probably useful in learning something, right? This is the one that I had added to my notes because of, I didn't know this when I first read it. And that's okay. If you read these and don't know it, sometimes you'll read these and be like, that text didn't say anything about that. It's fine. This is stuff to learn from too. You're not going to cover everything. You pick up new knowledge with these too. So this person has 2 jobs, works for public practice in the mornings and works as a member in the business during the evenings. Standards are inconsistent on how it treats members in public practice versus how it treats members in business. What should he do? Choose the most restrictive, which is those applying to members in public practice.
Forever to figure out what those are for.
Yes.
Yeah.
I hate those. This is not an old CPA question. So, you can just tell this would not be something they have used. They wouldn't do all those abbreviations like that. They would spell it out for you and maybe put those in parentheses. But that's not what you would expect on a CPA exam. Not a question like this. Other members, okay, what is that? No, they wouldn't do that. This is not a great written question here. but we did learn a little something from it, and that's okay. Number 2, which of the following is accurate? So we're looking for 3 things that are wrong, and then 1 thing that is right, right? So taxpayers must be independent in fact. I don't know if they specifically have covered this in that one section. But it goes along with what we were saying about only members in public practice must act with independence. There's taxpayers in public practice. Really, attest clients have to be independent, right? Or attest when you're doing the test services. Tax preparers, they don't have to be independent. Members providing consulting services must be independent. No. So long as they act with independence, auditors need not worry about objectivity or integrity. Obviously, no, right? Tax consultants must act with integrity and objectivity. See, if you'd read through all 4 of them, you'd be like, well, that is absolutely the right thing. Why would a tax consultant not have to have integrity or objectivity? Right? Everybody has to act with integrity and objectivity, no matter what, right? That's just kind of a throwaway. So number 3 is more of a reason through it type question that may require a little bit of background knowledge or experience. Which of the following is true regarding the principles of professional conduct? So A says to live up to the code of professional conduct, members may have to work hard, but they do not have to sacrifice their own best interests. B says members must not only be competent in the provision of professional services, they must also cooperate with other members to improve the art of accounting. Weird stuff here. C, you care in the audit area is satisfied if a member knows GAAP and gas inside and out. So that makes that one absolutely wrong. So that's kind of what I was saying. They're always throw these perfection type questions at you as this one is not right. D says because the code of professional conduct does not expressly prohibit a member from moonlighting as a circus trapeze performer, a member could perform at a local bar as Sam the Flying CPA. This is just stupid. An author wrote this. This is not an old CPA question. So that was just a silly throwaway. There's really no reason this could be wrong. It's weird though. What's this cooperating to improve the art of accounting? That's a stupid way to put something. I don't like this question very well. But the reason A is wrong, we're not called upon to, let me read this again. We are, I'm sorry, I didn't read how that was worded. We are called upon to sacrifice personal advantage. We're serving the public. So there are many things in the code, that's what I'm saying, a little background and experience, knowledge would probably help with this question as we go along. There are things where we do have to say, okay, we cannot do this. It serves our own personal interests and we're not really allowed to do that. We're serving the public. This doesn't need to be a thing. We can't be a part of this. So that's why that one's wrong. It's a really strangely worded question. Like I said, don't let that bother you. You just take from it what you can and move along. Right? Some of these are not the best. Especially in the broad introductory sections, it's hard to come up with questions on those sometimes. 4 says there's no, which of the following statements best explains why the CPA profession has found it essential to promulgate ethical standards and to establish means for ensuring their observance? Another author question here. So it's kind of a answer is really, how could you argue with it, is A. And that's what we're doing, right? We have responsibility to the public. That's what keeps us in business. We are serving the public. And again, like I said, these are vague and a little more difficult because of that. And this would not be a CPA question, but B is wrong because there's no legal requirement to establish ethical standards. We do it as a profession, so to be more credible, right? C seems to be a little more fine than the others, so it's kind of a tough call. C says ethical standards that emphasize excellence in performance over material rewards establish a reputation for competence and character. I guess that one's a little easier to argue with than A. You could say, well, does it? You know, that's find somebody who can argue with A. No. Like I said, this is not the type of question you would get, so don't spend a whole lot of time trying to reason through all of it. So some of these aren't the best. That gets us through the first section. Any questions on that? It's not a heavy section. Questions are a little frustrating. Okay. All right, well, let's move on then. MIPPs, members in public practice, introduction and conceptual framework. You know, you mentioned the whole abbreviation thing. I think they do that thinking it's going to make it easier for us, but it makes it harder. I don't like that type of thing. One thing you'll see throughout this semester, you know, this is taking stuff from the standards, and they'll keep saying a covered member must, a covered member must not, a covered member, blah, blah, blah. That gets to be too much. So if I'm taking notes, I usually don't say a covered member has to do this. I just say, you have to do this. You know, member in there. We know who we're talking about, right? So, you know, like a covered member shouldn't act discreditable. I would just say, you should not act in a way that's discreditable. You know, cut some of the junk out of your notes just to make it less taxing on you, right? That's what I do anyway. So public practice, we're talking performance of professional services. So that's audit, that's also tax, that's consulting, et cetera, for a client. So CPAs are covered here. The firms that provide those services are covered here. So we've got a code that has rules and interpretations in it. So this touches on what do you do if there's not a clear answer. You know, this code's not going to cover every situation, right? So that's what our conceptual framework is in place for. I could see that as a question. It's like, put this little scenario together where so-and-so can't find the answer to the question. What should they do? They look to the conceptual framework to guide them through a process of figuring out what to do. And that's all outlined here. You know, they look for threats. They see how significant those are. They look and enforce and apply safeguards. And it goes into detail what all this is. So it's a threats and safeguards conceptual framework. So, you know, we're trying to determine whether there are threats to our compliance with the code, you know, such as a threat to independence. So we want to try to reduce to an acceptable level those threats, right? So the conceptual framework is what you apply. Yeah, I can see that as a test question for sure. So categories of threats that you might consider as you're applying this framework. Should you memorize these? Absolutely not. It's too much. Should you be able to reason through what they're talking about? You will be able to if you read it close enough. You know, the good thing about most of this stuff is the term itself explains what's going on. Adverse interest threats. Okay? You can probably guess without looking at a definition what that would be. Once you read it, then you'll know for sure. But, you know, an example here would be a client threatens to sue. And you know, y'all kind of get into it with each other. It's going to be hard for you to be objective with your client if they're threatening to sue you. So there's some adversity there. Advocacy threats. I said I kept changing the word member with you, but I haven't done that in this yet. This is when I was early on making notes. But you provide forensic accounting, investment advising, underwriting, promotion, that kind of things for your clients. You're not supposed to do that. If this is an attest client, if you are supposed to be independent and you're supposed to be attesting to the fairness of their financial statements, you're not supposed to do any of this stuff either. You can advocate for a tax client or advisory client, but you cannot advocate for an attest client. That is not allowed. Example would be endorsing one of their products. You can't do that. Familiarity threat. Remember, you have a spouse or a parent or a sibling or a close friend that's employed by a client. It's hard for you to be objective in that setting. Logical things, right? Management participation threats. You're taking on the role of client management. For example, something like you're serving as an officer or director on their board or something. Obviously, you can't do an audit for them, right? Or something in their internal control system. Then you'd be auditing your own stuff, and you can't do that, right? So that would be a management participation threat. You have done things that the manager should have done. Self-interest threats. You have a financial interest in a client, or a firm relies excessively on revenue from a single client. That's a little more out there. So if you have a firm that you're auditing that relies excessively on revenue from a single client, this was a complex example. I printed up on this one. I should have come up with something better. Maybe I just won't say that. That's too much. Never mind. It's self-explanatory. That's just going to muddy it up. Self-review threat, relying on the work product of the own firm, or you do the client's bookkeeping, things like that. You perform internal control procedures at their organization. That's you your own work again. Undue influence threat. Client threatens to fire the firm or withhold future business unless you do this. That's a threat to your work, right? If they're trying to influence you in that way. So the whole idea is, if you see any of these threats that we just kind of listed out, you need to kind of take a step back as you're applying this conceptual framework. Ask yourself if this creates a threat to objectivity that is at an unacceptable level. If so, then you can do something about it. That's these safeguards that you can apply to hopefully get it down to an acceptable level. If you can't, you don't need to attest for this client. That's kind of it. So the safeguards, there are safeguards that the profession has created or legislation or regulation has created. There's ethics education and training, there's professional standards and discipline, there's external reviews, there's legislation, there's licensure requirements, all very broad stuff that you can breeze right through because you're like, how are they going to ask me a question about all this? Things implemented by the client, having knowledgeable and experienced managers, good tone at the top. Good tone at the top is always a good answer to a question. It's very important to everything. You'll see as we go. But this is just too broad to be useful. Strong leadership, policy, rotation of engagement team. These are safeguards that hopefully do some good. But you obviously can't only rely on safeguards implemented by the client, which is this category here. You definitely need safeguards beyond that. But there's just not a whole lot of good stuff here. This is, if anything, the meat of this chapter, and even that is pretty obvious stuff, right? The questions, there were 3 of them, and I didn't feel like any of them was worth really us even talking about. They were easy. We're not going to cover every question every week unless somebody specifically wants to look at one. So we're still very much introductory here. This stuff kind of runs in a very boring way. We start picking up more interesting things with this next chapter. So we're still in the code. We're talking about specific things that are addressed in the code. Here we're talking about conflicts of interest, gifts, and things like that. So this is a hot spot. I would expect a question or two on this. And when I say for test questions, I mean on the CPA exam, but obviously here too. But so conflict of interest. Here are some examples. Simultaneously advising two clients who are trying to acquire the same company. How could you do that correctly, right? You want a company and you want the same company, and I'm advising both of you. That ain't gonna work. Preparing a valuation of assets for two clients, one who's the buyer and one who's the seller. A big conflict of interest. Advising a client to invest in a business that's owned by you. Obviously, that would be a problem. Or owned by a relative. Obviously, that would be a problem. So that's the good thing about these types of things. They're usually obvious. Now, when we start getting into independence rules, they get very specific. But you just have to start looking at percentages and things. But these are real obvious things that you wouldn't be able to do. Advising a client on acquiring assets that your firm is also wanting to acquire. Obviously, that's not a good thing, right? Providing forensic accounting services to a client who seeks to sue another one of your clients. Referring a client to a provider who in turn refers a client to you. These are all good examples of conflicts of interest. And, I started with the notes, kind of like I just said a minute ago. These are logical things. So all you're doing is saying, would a reasonable person conclude that this is a problem? That's what you're looking for. These are all obviously problems, right? So the whole idea is don't accept an engagement if there are these things here, right? If these potential conflicts of interest threaten your independence and threaten your objectivity, don't accept the engagement. And once you've accepted it, keep monitoring and make sure these things don't come up too, right? I highlighted this in red because I just thought it was a little too out there to worry about all this network firm stuff. I don't know. That's my opinion. I don't think that was worth focusing on so much yet, if ever. So evaluating conflicts of interest. So when you identify a potential conflict of interest, you should apply the conceptual framework. Refuse the engagement if you find it to be unacceptably high and you can't get it down to a good level, or if you're already part of the engagement, terminate it. But safeguards to reduce the threats could be having a separate engagement team on each of the conflicts in question. That could possibly mitigate it to the extent where you're okay. Limiting access to clients' files. These people over here can't look at this over here to keep the conflict, to keep a wall kind of between the conflicts, right? Confidentiality agreements, regular review by a senior manager who's not involved in the engagement. It's a good idea. It's a good idea to document anything and everything that they make the point. It's a good idea to document this process of reducing threats and things. That's pretty logical stuff, right? Disclosure of conflicts of interest. All right, so highlighted this in green. Even if threats to compliance are at an acceptable level, you should definitely disclose to the clients and to the affected third parties, hey, this is happening and we want you to know about it. Okay? That is important when it comes to conflicts of interest. So you could have a specific disclosure as your closest competitor who would love to have access to your confidential information that we possess. We will blah, blah, blah. Let you know this so you're all above board on everything. Or more general disclosure, we audit several firms in your industry sector and we are going to be sure to not screw this up. Right? So disclosing is very important. So this section is called conflicts of interest, and then directorships, and then gifts. So there's really 3 in one here. So we shift gears to director positions. We can sum that up by saying, don't be on a client's board of directors. You could be a consultant to their board, but don't be on the board of directors of someone you're auditing. That is a problem, right? Gifts and entertainment can be a threat to objectivity and integrity. If the client, and by the client we mean officers, we mean directors, we mean large shareholders. The client could be a lot of people. If they give you gifts or entertainment, or if you give them gifts or entertainment.
This is the first question on this section.
Kind of vague.
They're kind of hard for me because one of them, it said that they gave them a really expensive gift and all this other stuff. And then the other one, there were 2 that confused me. The other one was like, you knew it was their birthday. You gave them a ticket to a game that you knew they wanted.
We'll look
That
at
wasn't
those.
the right answer.
We'll look at those and talk about those. Yeah. And again, just because you couldn't make if you couldn't reason through their questions, it could just be a bad question. Always remember that. Yeah, you may be fine in understanding it perfectly, but they go on to say there's definitely a violation if the gifts or entertainment violate laws, regulations, or if it violates policies and that kind of thing, or the client's policies. If no rules are violated, then there is no problem if the gifts or entertainment are reasonable in the circumstances. How do we define reasonable in the circumstances? That's going to involve judgment. You just kind of have to ask yourself, could I justify to someone questioning me if this is reasonable in the circumstances? So let's look at the questions. Let's see what we're thinking here. There's 4 of them. There's 5 of them. A couple of these were really good, actually. Number 1 says, firm does not wish to have its integrity or objectivity compromised by the fact its tax client is a constant giver of gifts and entertainment to its outside consulting, law, and accounting firms. Which of the following should we keep in mind? I always make these first person type things. I always put myself, I am the firm, we are the firm. Just helps me kind of frame the question a little better. So I do not wish to have my integrity or objectivity compromised by the fact that my client gives gifts and entertainment to outside consulting, law, and accounting firms. Okay, what should I keep in mind? As long as the gifts are given by the company's owners, but not the company itself, that makes sense, does it? So let me throw that one out. B says the accountant should remember that a violation of the integrity duty is presumed if they receive gifts that violate rules and or reckless and not knowing. I mean, that's obviously right? It's a lot of words that you have to kind of focus on and work your way through, but nobody's going to argue against that. We are violating our duty if we receive gifts that violate our rules. Obviously, once you decipher what the heck they're saying, this is an easy question. Gifts that a jury would find reasonable in the circumstances are fine, even if they violate an official policy of that person. No. No, obviously no. And then D says gifts of entertainment are treated differently for these purposes than gifts of objects or money. I mean, I wouldn't automatically know what to say to that one. It's not walking around knowledge, but no, that's not the right answer. But B is obviously correct. 2, I thought wasn't the best. That's not the one you were talking about, is it? If it's not, we'll skip it. Because I thought this one wasn't. I thought this was a little more opinionated than factual, in my opinion. 3, in which of the following situations would member taka, not be in a conflict of interest. So A says they're giving financial advice to both a buyer and a seller in a commercial real estate deal. That's obviously a problem. B says they're giving financial advice to both a husband and a wife in a divorce proceeding. Obviously, that's a problem. C says providing advice to a company as it readies to buy a large office building, knowing that our firm is also planning to bid on it. That's obviously a problem. D says firm is bidding to buy attractive real estate that's owned by a company that was a tax client of the firm more than 10 years ago. We're good there, right? This was a pretty good question and easy to reason through. I like this one. 4's good. Bozo, all right, I'm gonna make us the firm. So Bozo hired us to support, and it's our tax client. No, we can't do that. Okay, I totally read that wrong. Obviously, we can't do that. Okay. Yeah, it's hard to decipher these sometimes. We can't do that. Juan suggests that his tax client, Linda, invest in her tax refund in Blitz without saying that I own a big old stake in Blitz. Obviously, that's a problem, right? Hey, get your refund. These are great stock right here. It's mine. Nope. Tibble and C recommends that his tax client hire a financial planner without disclosing that that financial planner has agreed to refer all his clients in exchange. So that's a problem. Okay. So all these are a problem. Easy once you can decipher what they're saying, but A almost screwed me up there. And then 5, if Maria has ABC for an test client, from which of the following should she be wary of accepting gifts that might threaten her objectivity? All right, so I guess we're Maria. So we have ABC as our client. Who should we not accept gifts from? Obviously, we should not accept gifts from ABC or their officers or their major shareholders. So all 3 of these are fine. That one you're talking about must be in another section.
Yeah.
We'll get to it. All right. So that's why I say things like the more of these questions we can do, the better, because you get a feel for things to not screw up. Like I read that wrong. Like, oh, that's fine. I didn't do that question. I wouldn't want to make that mistake again. All right, question or comments on that section? All right, moving along, we're still in the Code of Professional Conduct. This has to do with reporting income and subordination of judgment. There's a lot of obvious things in this chapter, in my opinion. To me, the real takeaway here is the proper procedure that you go through when you disagree with a supervisor. All this other stuff is super obvious, right? Violating the code if you make false entries, of course, or direct somebody else to make false entries. Obviously, you can't do that. Or if you failed to correct misstatements when you could have and should have, or if you did something with misleading documents, or if you were trying to mislead somebody, or if you relied on stuff you shouldn't have relied on, you didn't do your work, obvious stuff that you're good on, you should be good on, right? So, and then they go on to say, if you later find out that information you're associated with is misleading, your responsibility is to get the information correct and inform users who have already been misled by it. If a wide group have been misled by it, then you need to figure out a way to broadly reach that wide group. But subordination and judgment, this is a little better content here. So if you disagree with a supervisor over some issue, it's really tempting in the real world, trust me, to just, especially when you're first starting out and they say, yeah, you need to do this, you might not give it a second thought and just like, okay, that's what I'll do. Along the line, you may end up disagreeing with them. So don't just do what they say if you disagree with them. So here's the proper procedure. And 2 and 3 is really where test questions usually get up on. The first one is evaluate whether the threat is unacceptable. That's a judgment call, but it would be unacceptable if the position taken would result in a material misrepresentation or legal violation. If it's not a significant threat, then you're done. It's not a big deal, right? It's fine. But if we're talking big things here and you're like, I don't agree with you who are my boss, your duty then is to discuss the matter in the next step with the supervisor. If that is not something you reach a resolution on, then you're supposed to go over the supervisor's head. If that does not resolve it, then you need to look at the organization's policies and procedures about how to report differences of opinion, figure out whether you have a duty to report it elsewhere, but really you should consult legal counsel before you do anything like that. Be sure to document the situation, obviously. But if you get to the point where you're out of ideas and there's no resolution, you might want to quit the firm and figure out how to eliminate your exposure. Nothing precludes you from getting out of there at any time. Now, that wouldn't necessarily discharge some of your obligations if you had an obligation to report to regulatory authorities or something like that, but get out of there if you're in a situation you don't need to be in. And don't pressure others to breach the rules. And then there's a big old list of obvious things that you shouldn't do. This was a very obvious section, in my opinion. The questions here were fairly obvious too. 4 and 5 I thought were the best. Son is a junior auditor from ABC firm, audit team. These are so hard to get straight. Son is an auditor for ABC firm's audit team, and their client is Mammoth. Okay. All right. So we're going to be Son. So we are an auditor, and our client is Mammoth Corporation. We believe that their CFO is mischaracterizing some important transactions. The CFO is adamant about the treatment of these transactions, but after doing substantial research and consulting with our supervisor is in agreement with the Mammoth person. We believe that following Mammoth's preferred treatment would produce inaccurate financial statements that would materially mislead investors. What should we do? So we got a client wanting to do something shady and our supervisor agreeing with them. We don't like it. What do we do? Well, do we immediately resign? No, we try to solve the problem. So we're not going to just say, yep, we quit. Do we immediately go and say, hey, SEC, we're doing this? No. Do we make our concern known to higher levels and or the client and resign and inform? No. Our first step here after this would be make our concerns known above that person's head and or the client, and then proceed down the line of what we were talking about earlier. 5 was a good question too. Which of the following is or are true regarding auditors who disagree with their supervisors regarding the proper handling of an important transaction? We should always stop there, right? You see the word always there, it's probably wrong. We should always defer to the supervisor, who, after all, has superior experience, obviously not. We should always quit on the spot. Okay, no. What did I say? You see always, and it's probably wrong, but I guess one of them is going to have to be right. We should always discuss the matter with the supervisor if it appears there are a significant threat that the financial statement yeah, I guess they should probably get always out of there anyway, because you could argue you don't always do that. What if they pulled a knife on you right then and there? Then you would run. These CPA questions have to be, kind of infallible where nobody can argue with them. So always needs to go. But that's the right answer. These others were kind of obvious and easy. In the interest of time, we can move on. Questions or comments? Like I said, this earlier stuff's a little more boring than some of the stuff to follow. We haven't hit on a tremendous amount of meaty stuff yet. Advocacy, third-party service providers, general standards, accounting principles. So we're hitting on 4 areas in this section, which means those 4 areas are little. So there's little tidbits here. Client advocacy. If you're doing a test work, you may not advocate for your test client. We already said that, but that's obviously important. If you're doing non-attest work, you may advocate for your client, but you should be careful to avoid zealous advocacy, they call it, that a lawyer would often provide. So, if you're dealing with an attest client that you have to be independent and tact and appearance for and all that, advocate for them. Tax client would be fine though.
When I say advocate, I mean like legal. Right?
Let's see. I was trying to come up with some words to kind of say exactly what you were just asking. Yeah, that's pretty much it. Because they do go on to equate that to don't go as far as a lawyer would go. Yeah. So yeah. I think of a better way to even say it, but it's about the best way, I think. Didn't we mention that elsewhere in the earlier section? No, okay. So you wouldn't want to be like an underwriter of them. You wouldn't want to do investment advising. You wouldn't want to promote their stocks or whatever, that kind of thing. Things along that line, yeah. Not for an attest client. Use of a third-party service provider. If you're outsourcing work to a third-party service provider, this can often threaten objectivity or integrity. Not necessarily. It's fine if you're only doing administrative type things like storing their records or that kind of thing, hosting software applications, that kind of transmittal services. But if you are, if there are substantive services being outsourced, then your client should be notified for any confidential information is provided to a third-party service provider. So yeah, we're kind of worried about confidentiality types of things here. Kind of vague, kind of not that important. Just a quick little tidbit, just so they can get all the information there, I guess. General standards. You should take on jobs only if you can complete them with professional competence, obviously. You are employing a specialist to provide consulting services, then you should have the ability to define the tasks that you want of them and evaluate the results. But there's some things that you'll need a little bit of expertise on that you may not specifically possess. But you do need to know enough to direct them in what you want and evaluate what they provide for you, right? Here's this again, you don't have to be perfect, but you should always exercise due professional care. So you'll see that time and time again. Don't have to be perfect, but you do have to carry out your duties with professional care. These are general standards, like we said. So this kind of very broad stuff. You always have to adequately plan and supervise your services. Obviously, you wouldn't want to do services without planning them or supervising them. It's obvious stuff. And you should never render conclusions without having sufficient relevant data to support it. Again, obvious stuff, right? And then under the accounting principles section, follow GAAP and other relevant accounting principles. A departure from GAAP is appropriate if GAAP would mislead. So that could show up, in an oddball test question. Like, oh no, we don't depart from GAAP, but yeah, if it's appropriate, it would be appropriate if GAAP would be misleading. And an example when that could be the case is if things are changing and the standards hadn't kept up yet, and new legislation or evolution of some new form of business, and we don't have a good way yet to deal with it, that kind of thing. GAP's usually fine. So yeah, that was it there. I felt like all of the questions in this section were good. And I felt like all of them were extremely straightforward. Members may properly do which of these? Advocate on behalf of audit client. We already said no. Advocate on behalf of tax client. Yes. Very straightforward. There's two things here. The code, if we did which of these in an audit, would we violate the code if we stated that we were not aware of any material modifications that should be made when we are in fact aware that they are? Obviously, that would be a violation, right? So that would be a violation. Would it be a violation if we stated that we were not aware of any material modifications that should be made? If we were aware of immaterial modifications that would be desirable? That's fine, right? Materiality is an important concept we'll hit on later, but immaterial things are just that. They're immaterial. If it's not material, that means it does not have the ability to cause somebody to base their decision on it, right? So if we're saying, hey, these modifications would be good, but they're immaterial. If they didn't do it, it's like, yeah, whatever. It doesn't matter if it's immaterial. If it is material, it's a problem. That's a good question. Materiality does enter into a lot of these doesn't matter questions. 3, according to the profession's ethical standards, which of the following events may justify a departure from GAAP? So that's kind of a throwaway. Both of these would. 4, the same person wrote all these. Let's get down to 5. I thought 5 was the best one here. Sally has her own small accounting firm. For Sally, due to some personal connections with a top officer of this company, we landed an interview with them as a potential tax client. The company has some complicated tax issues of a type that we have not handled before. Which of the following is true? All right, there's a lot of pieces to this that we may have to revisit. So let's see. One says, because we have not handled these complicated issues before, we cannot take the engagement. All right, you'll see this a lot. It doesn't matter, all right? That's not a standard. Obviously, you're always going to have to do some engagement the first time, right? So not having done it before doesn't mean you can't do it. You just have to prepare yourself to do it. You have to educate yourself to the necessary point where you can. So you can accept an audit engagement without knowing a lot of things, as long as you start educating yourself before you start carrying out the duties of the engagement. This is just for tax one, but it's for the audit too. So that's okay. 2 says, I can take the engagement if I believe in good faith that I can research these tax issues and handle them competently. Okay, so it's saying which of the following is true. I always have to go back and see how they frame the question. That is true. So we like 2. 3, which of the following is true. We can take this engagement if we believe in good faith that we can consult with experts in the area and handle these companies. That's fine too, right? So these would both fit into the category of properly gearing up to do this. So 2 and 3 are both fine. So D is the answer here. That was a good question. Straightforward. Keep moving. Okay, discreditable acts. This is always an easy section. We know what is and isn't a good thing to do. We have lived life. So there's a whole big old list of obvious things given here. You don't have to, without even listening to those in notes, the things you should and shouldn't do. So just to streamline all that, you should not commit discreditable acts. You'll know when you see them. What I did kind of commit to the notes was about records requests. This is a specific area here. This is pretty important content right here. I would take good notes on this. This is the type of thing they like to ask test questions on. So records requests. So that means one of our clients is wanting the records back. Well, our duty depends on what type of records we're dealing with. If they're wanting records back that they had given us, we got to give it to them. Even if they hadn't paid their bill, it's theirs. We can't withhold it. So this client provided records, those are going back as soon as they ask for them, no matter what the circumstances are. We do not keep those. Okay? So that's for client provided records. Member prepared records. So these are records we were not specifically engaged to prepare. They're not in the client's records. And it would render the client's financial information incomplete. Things like adjusting entries, closing entries, combining entries, supporting schedules, consolidating journal entries. So the rule of these are they should be delivered to the client at the client's request, but they may be withheld if fees are due for that specific work product. Should that say records you were specifically engaged to prepare? Y'all have any notes in around this key there? Or your book, maybe?
So why is it not specifically engaged there?
Okay, I just want to make sure. It hit me funny when I read it the first time. Okay. Members work product. Okay. Man, covered it here. Never mind. I should have kept reading. Deliverables that are set forth in the engagement letter. So these should be delivered at the client's request, but may be withheld if there are fees due for that specific work product, or if the work is incomplete, or to comply with professional standards such as withholding because of unresolved audit issues. Or we can withhold them if we're threatened, if there's threatened or outstanding litigation concerning the engagement of your work. Working papers that's our stuff that we did to carry out the audit. We prepared it for the purposes of the engagement. That's our audit programs, that's our sampling, that's our analytical reviews. Those are ours, and we don't have to give them to the client unless there's some contractual provision that we do. So there's 4 things there. So client provided records, give it back to them, doesn't matter. Things we prepared that we weren't specifically engaged to, we can hang on to them if these reviewed. Things that we prepared that we were engaged to, those go back, but they may be withheld for these lists of things here. Our working papers, they're ours. We don't get them back. So take a note of those 4 things. Those are hot areas for test questions. Generally, these requests should be honored in 45 days. That seems really long to me, but that's what it is. And you may charge a reasonable fee for the time and expense of producing the records. And you don't have to convert them to certain formats or anything like that. It's kind of a few odds and ends that threw on us there. So yeah, so on the questions, well, first one was pretty straightforward, but look at number 2. It's a little tougher, kind of subtle. Client Lewis has demanded return of work product produced by us. We are resisting the demand. Which of the following is not proper grounds for us to deny returning that stuff to them? Which is not proper ground. So they owe us money for the work we did that is unrelated to the documents. 2 says they owe us money for the work we did in preparing the particular documents they're asking for. C says the work product is incomplete. And D says they have sued us and these records are subject to a disputed discovery request. All right. So I just read through all 4 of those real quickly, and I quickly throw in C and D out, and I'm going to have to read closer A and B because it's kind of down to those 2 in my mind as I'm reading these, right? C and D are quick and easy. It doesn't take a long time to really digest that. But now I need to reread A and B and kind of decipher in my head what's going on, right? So they owe us money in A for work we did, but that money they owe us has nothing to do with these documents. B says they owe us money for the work in specifically preparing these documents. So which of those 2 is not a proper ground? I have to reread these questions all the time. It's so hard to frame them. Which of these is not a proper ground for us to deny the return? Okay, so A is not, we can't argue that. Right? And say, hey, we want our stuff back. And you're like, hey, you owe us money for some of this stuff over here, so we're not giving, we can't do that. This was tough to decipher for me. It's very subtle wording. And then you have to go back and see how they frame the question. I know that one was a little tough for me. 4 was kind of tough too, I thought. Which of the following actions by a CPA most likely does not constitute an act discreditable to the profession? A says sexually harassing an employee. That's obviously an act discreditable, right? We're looking for one. I always have to go back and say, are we looking for one that does or doesn't? So we're looking for one that does not. So A definitely does. B says providing for a right of contribution from the client in an audit engagement letter. We don't even know what the heck that means, do we? I had to look that up. So that's essentially a deal where the auditor and the client have to chip in if there ends up being an issue. Okay, that was new knowledge for me. I didn't know what they meant by that. I had to Google it, I think. So that's typically allowed. Why wouldn't it be? But C says providing for the right of indemnification from the client in an audit engagement letter. So indemnification lets somebody who does something wrong completely off the hook. It's kind of a release form, and that's not allowed. You can't say, hey, if I do something wrong, you can sue me. No, you can't give yourself that right. So C, wait, B is the right. Back to the question again. B is the one that does not constitute an act discreditable. 5, 6, and 7 are good too. Spinner had audited Lasco's financial statements for the past several years. So you're a Spinner here. Prior to the current year's engagement, a disagreement arose that caused them to change auditing firms. They have demanded that we provide them with our audit documentation so that they may show them to prospective auditors to help them prepare bids for the audit engagement. We refused, and they commenced litigation. Under ethical standards of the profession, will we be successful in refusing to turn over the documentation? All right, this is a good question here. And I think we really pretty readily know the answer to this, right? Just kind of have to find it. In my head, I'm thinking through and I'm like, yes, I'm good here because this is my work papers and they are not entitled to it at all. I just have to find something that says that. And A does, yes, because we are the owner of the audit documentation. It's a good question. 6 is a good question. According to the code, which of the following actions by CPA most likely involves an act discreditable? A says refusing to provide the client with copies of audit documentation. That is not an act discreditable. We're fine there. Don't have to do that. He says auditing financial statements according to governmental standards despite the client's preferences. Who cares what the client prefers? We're going to do what we're supposed to do, and that's obviously fine. C says accepting a commission from a non-attest client. Okay. I guess we've really gotten into that yet, but look at D, retaining client records after the client demands their return. That's obviously something we can't do.
I can climb on up there.
Pardon? Was somebody talking to me? I think I just picked somebody up talking to someone else. Number 7 is a good one too. Which of the following actions by a CPA most likely violates ethical standards? I like these questions because I don't know, they're usually pretty easy to answer. A says arranging an institution to collect notes issued by a client in payment of fees due. B says compiling the financial statements of the client that employed the CPA spouse as a bookkeeper. C says retaining client records after the client has demanded their return. Read through them and look for the one that just jumps out and smacks you. That is a violation. If you read through and none of them just reaches out and smacks you, then you kind of have to read a little closer. But usually my strategy on stuff like that is quick read, quick read, quick read. There's the obvious one, move along. Otherwise, I'd have to go back and be like, all right, let's think. Compiling financial statements for this person. They employ, a lot to think about. But if you just read through and one of them jumps out, it's obviously the right answer. Saves you a little time and effort. Questions or comments on discreditable acts?
Would we not do the income number 7 because it's not really an ethical thing? Or is that generally okay?
What's the deal with B? Is that what you're asking? So it's really getting ahead of our knowledge at this point. So this is about a compilation, and we can perform a compilation without being independent. That's fine. Yeah, that's the thing about some of these questions. Some of the answer choices get ahead of the knowledge you've gotten so far. So that's the case here. We can do a compilation.
Yeah.
On the report, we have to state that we're not independent and all this stuff. And we'll get there way toward the end of the semester, actually. But we'll get to that point. Any other questions or comments? Okay. Fees. Contingent fees, commissions, and referral fees. So this is all pretty important stuff to definitely take note of with these contingent fees and the commissions, but definitely with the contingent fees. No contingent fees for any service if you do any of the following for the client: audit, review, examination of prospective financial statements, compilation that does not disclose the lack of independence. If you do that service, any of those, there's no contingent fees for those, or for anything that you do for that, actually. So you just kind of, contingent fees are out of the question for anything going on with that client if you do any of these things. No contingent fees for preparing a tax return. For obvious reasons, right? You know, that gives you the incentive to kind of tweak that tax return to your advantage. You don't want that, right? No contingent fee for an amended tax return claiming a refund because of an error in the original return. You know, these are things you can't do. So what can you do? Here's what you can do. You can do work, tax work, for a non-attest client. If they're an audit client, this is out of the question. That's kind of what the first line item up here drives at. So if you are doing tax work for somebody and you don't do audit or any other attest work for them, then you can do some things for a commission, such as representing a client before a revenue agent, examining their tax return, filing an amended return on the basis of a tax issue that's subject of a test case involving a different taxpayer, really complex stuff. Filing a return, claiming a refund that will be examined by a tax authority, helping a client obtain a private matter ruling. So pretty out there stuff. So I wouldn't memorize those examples or anything, but it's nice to have examples of things just to kind of glance at. This one's a little out there and beyond where we're at this point, but you can have a contingent fee for a compilation to be used by third parties as long as you include a statement that you're not independent. But that's a little out there. So don't worry about that, especially at this point. Commissions, no referral fees for attest clients. There's just not a whole lot you can do if your client's an attest client. So no commissions for anything, no referral fees for anything. But for non-attest clients, they're permitted as long as you disclose them. So that is important. Your spouse can receive a commission from your attest client as long as your spouse's activities are separate from your practice and you're not involved. It's a little out there too. You may sell a product to a client at a profit without disclosure. Business stuff. You may subcontract a service to a third party and mark up the cost without it being considered a commission. So those things are a little very overly specific. So basically the things I highlighted in green are the main takeaways here, honestly. Number one kind of, I think, drives the point home, even though it's a very obvious question. It's a good question. Which of the following is an example of an impermissible contingent fee in the tax area? Which of these could you not do? So A says we represent a tax client before a revenue agent examining their tax return. B says we notice that a taxpayer filed a lawsuit against the IRS in another state claiming a particular deduction that our client might also be able to claim. So we filed a similar suit on their behalf. C says we screwed up on their return. So you're already like, well, that's going to be the one. We screwed up on their return, but noticed the error and filed an amended return claiming a refund and wanted a contingent fee for it. Yes. Always look for the one that smacks you in the face. That one is obviously something you can't do. D says we help the client seek a positive letter ruling from the IRS. whatever the benefit was to the client. 2 also makes a good point. In which of the following scenarios has Ed, a CPA, not committed an ethical violation in relation to Harriet, who's a tax client? So Harriet asked us what she should do with a $12,000 tax refund she received from the IRS. I thought this is kind of a good question here. So we're Ed here. So we referred Ed to an investment advisor without disclosing that that advisor was our sister-in-law. We're looking for the one that has not committed an ethical violation. So we've obviously not done a good thing in A, right? B says we referred her to an investment advising firm without disclosing that we are a partner in that firm. Obviously, that's a problem. C says we recommended that she investment instruments from this firm, and we did not disclose that that firm paid us a 5% commission on those transactions. Still a problem. D says we sold her an investment instrument, and we did disclose that we're earning a 5% commission on the transaction. That one's okay because of this. So the key with the conflict of interest is disclosure. There's no problem as long as you disclose that. Disclosing conflict of interest is the way to deal with a conflict of interest. So this one's right. So do keep that in mind. With all these others, it was without disclosing. Without disclosing. Without disclosing. Oops. That's the key takeaway from this. 3 is really straightforward. 4, assuming appropriate disclosure is made, which of the following fee arrangements generally would be permitted under ethical standards of the profession? A says a fee paid to the client's audit firm for recommending investment advisory services to the client. There's not a whole lot we can do if it's an audit client, right? So keep reading. A fee paid to the client's tax accountant. Okay, now we're talking possibilities here. We're not as limited if it's just tax services. So a fee paid to us, a tax accountant, for recommending a computer system to the client. That's okay, right? It's a tax client. We can do that because it's a tax client. We're not needing to be as strict. C says a contingent fee for preparing a tax return. You can't do that, right? You can't just do a contingent fee on a tax return. You can do it for those oddball, really out there things that we listed, but not for just amending a tax return, and not for a review. That's an attest service. We definitely can't do a contingent fee for that. Good questions here. Good examples of good questions. 5, I just glanced at the answers and didn't even read the question. I said, well, that's definitely the answer. Which of these is not like the others? So, which of these could you get a contingent fee? Audit, no. Review, no. Examination of prospective financial statements, no. Letter ruling. Easy little section here. Advertising your firm cannot be false, cannot be misleading, cannot be deceptive. Pretty obvious, right? Confidential information. This is a little better information to take with you. So your client's information, you shouldn't disclose that. You can, if you get consent from the client, you're good. If they say, yeah, go ahead and do that, you're fine. If they don't, then you wouldn't want to disclose it unless it was required by law. Examples would be a subpoena, And maybe a less obvious example would be, I just listed here, quality review request by the CPA board, but maybe to expand on that a little bit, I guess the toughest takeaway, subpoena is obvious, but maybe the toughest takeaway from the confidential information stuff is, you can disclose confidential information to a state CPA society. They're CPAs, they're bound by all these things in the code, just like we, the other CPAs are. So they should keep the information confidential among themselves. So an inquiry from the ethics division of the AICPA would be fine. Same deal as, the quality review request by the CPA board. Peer review is fine, obviously, too. So that's pretty much it, though. It is actually not fine to present confidential client information to the IRS or the SEC. If they want that, they have to get a subpoena. So you're fine disclosing confidential information to the state CPA's board or whatever, for those legitimate reasons. You're not just going to hand it off to your buddy to look at. It would have to be something like a peer review or an ethics inquiry or that kind of thing. But if the government entities, the IRS, SEC wants it, they gotta have a subpoena for it. I should have that in the notes. I don't know why I don't. I kind of do. I mean, I guess I just didn't say it in as many words as I just did, but that captures it right there. The rest of these are kind of a little out there as far as a little too detailed, but I stick them in there anyway. If you taking on a new client would likely lead to you disclosing confidential information for an existing client, you should not take the new client without consent. You can do any of this with consent. If you withdraw from an engagement, you should, if contacted by the potential successor auditor, you need to call the client and ask permission to disclose stuff to the new auditor. There's a whole process involved with that we'll get to later anyway. If you're outsourcing some of the work to a third party, you should either contractually bind the third party's confidentiality or seek consent from the client. And then this last one, disclosing a client, and this is something you wouldn't automatically know, but it's okay to disclose a client's name. That's permissible. But there's a situation where it wouldn't be permissible if it would disclose confidential information by doing so. For example, if you do bankruptcy work, you wouldn't want to disclose any of your clients' names, probably, right? So there you have it, short and sweet. All the questions were pretty useful in this one, though. 11. Number 2. We have T and W as audit clients. T is a significant supplier of raw materials to W. We also prepare tax returns for the parent company that owns T and the parent company that owns W. So complex. When preparing the parent company of W's return, I think it's just a guy, but whatever. We find information that raises going concern issues with respect to W. Okay, this is a lot, right? May we disclose the information? So first of all, on your head, you're like, well, no. I mean, this is confidential information between two clients that deal with each other. So no, we're not going to be able to do that. So which of these no's are we going to answer? C says no, because the information is confidential and may not be disclosed without consent. That sounds very good, right? I would go back and read who West was in this again, just to make sure they're the ones that would need the consent. D says no, because the information should only be disclosed in the audit report of W4 financial statements. So it's a lot to sort through. I kind of sped through it here more than I would have in reality, but yeah, That's a good, that's a good question. Number 4, I think I like. The CPA in public practice may not disclose confidential client information regarding auditing situations without the client's consent in response to which of the following situations? To read that again. CPA in public practice. So we may not disclose confidential client information unless they consent. We can always do it if they consent in response to the following situation. So where can we not? So A says a review of the CPA's professional practice by a state CPA society. We're good there. B says a letter from the IRS. They need a subpoena, right? So that's going to be the answer. C says an inquiry from Professional Ethics Division of the CPA. We're good with the CPAs, right? And then D says a court order subpoena. Okay, we're good there. So just a mere letter from the IRS is not enough. Yes, D is right. Thank you. So that's a very good question. That's something like you would see for sure on the CPA exam. 5 is very good. CPA's audit documentation. A says need not be disclosed under a federal court subpoena. Would need to disclose it under a subpoena, right? B says it must be disclosed. Okay, yeah, it is B. Okay, sorry. The hardest part of these questions is just figuring out the words. I'm like, all right, what are they saying? Okay. Yeah, you do have to disclose it under a federal court subpoena. So that one's wrong. You must disclose it under an IRS administrative subpoena. Subpoena makes it okay. I know the word. I know what I'm looking for. I'm just trying to figure out which of these is worded correctly. But yeah, must be disclosed under there. C says it must be disclosed to another accountant purchasing the CPA's practice, even if the client hasn't given permission. Nope. And D says it need not be disclosed to a state CPA society. No, we would need to disclose it. So the hardest thing about this is just getting the words figured out for me. I know the answers, I just can't figure out which of them is wording it the correct way without drilling down into it. 6 is good too. Which of the following statements concerning an accountant's disclosure of confidential client data is generally correct? Disclosure may be made to any state agency without a subpoena. Disclosure may be made to any party on consent of the client. We've said that time and time again, right? Disclosure may be made to comply with the IRS audit request. No subpoena. Disclosure may be made just for the heck of it. And with that, you can tell that one of the Wiley authors wrote that question because that would not be on CPA exam, that kind of thing. But yeah, if the client consents, we can disclose whatever they consent to us to disclose it. So I think we get a feel for that pretty good there, right? Pretty quick and easy. This one's quick and easy too. Form of organization and names, things you can and can't do. Names of past owners may be included in the name of the firm even when they're gone, right? That's true for a lot of firms we know, the big fours and things like that. This second little section is a little more out there and not as important, but there it is anyway. You can own an interest in a separate business that performs accounting, tax, or consulting services. But if you control the separate business, then its owners and employees must comply with the code for issues such as commissions and referral fees. I see that and I think, I'm not gonna worry about that. That's too much. That's my test taking strategy on that. Figure if I got one question on that, I could probably reason through it without committing that to my notes. So if this was my notes for studying, I would probably just delete that. It's just a little too out there for me to worry about. That's my opinion. But however you want to do it, just opinions. But this next little section is got some more important stuff for sure. If the firm does a test work, audits, reviews, that kind of thing, they're testing on something in compliance, then CPAs, certified public accountants, must own a majority of the firm. So if we do any kind of a test work, we've got to have majority ownership by people, comma, CPA. Passed the CPA exam, met the requirements for keeping that license going, experience requirement, all that. And the CPAs must remain responsible for that attest work. So that's a rule. So this is just for a test work. CPAs must own the majority of the firm and remain responsible for the attest work. If you are going to designate your firm as members of the AICPA, every one of the CPA owners are members of the AICPA. Therefore, everybody has to be CPAs to be a member of the AICPA. So there you go. Must be 100% owned by CPAs, and they must, otherwise you can't designate itself as designate your firm as a member of the AICPA. Those are good test question type things right there. And that bottom thing is not as important. You're in a partnership with non-CPA, but you are a CPA, you can still say so-and-so CPA. Obviously, you know that. All the questions here were very simple or very straightforward, so we'll keep moving unless anybody has any questions or comments on any of that. Just a lot of facts this week, not a whole lot of anything else. All right, now we get into some stuff. And we'll be on it for a little while. All this independent stuff. It is heavy, heavy hit. Heavy, heavy hit. All this independent stuff. They'll get very specific on you. They'll give you these very specific scenarios. So be ready. Independence is a big deal. So we are going to start kicking it off right here, right now. So we've mentioned it already. You do have to be independent of your client if you're performing a test service for them. We know that. We've said that. Examples already. And we've also said if there's not specific interpretations or code sections themselves that resolve the issue that you think might impair independence, like we said in the second section, you apply that conceptual framework from there, right? Threats to independence in general are financial relationships. For example, you should not own stock in an audit client. Employment relationships, you should not be on the board of an audit client, for example. There's going to be more than this, but this is just kind of broadly going over the big categories here. Family relationships, for example, you should not audit an audit client who has your wife as the CEO, for example. Consulting relationships, you should not provide internal audit services for an audit client. That's just one example of each of those, but there are many that we'll look at along the way. These rules apply and must be followed when relationships exist during the period covered by the financial statements that you're attesting to and during the period of the engagement after the financial date. So that's specifically how long these independence rules need to be followed. That's the period of time. Covered members. I get sick of seeing the term covered members. So here's what they mean. There's a lot of covered members, and these are the people who these rules apply to, covered members. We're talking engagement team members have to follow the rules. A person who can influence the engagement has to follow these rules. A partner, but not a partner has to follow these rules, but an exception. Not a partner in a different office from where the audit team is anchored. So there's a little exception to that. So it would have to be a partner in the same office where the lead audit team is. They're a covered member, covered by these rules. A partner equivalent, which we defined that random thing earlier. A so-called 10-hour person, which is defined as a manager who provides more than 10 hours of non-attest services to the attest client. And the attest firm itself is a covered member. And the attest firm's employee benefit plan. Get a little out there with that one. So these are all covered by these independent rules. Team members, anyone who can influence engagement, partner in the same office where the audit team is, 10-hour person, and the audit firm itself. And that is all covered members. So that term will pop up quite a bit. Number one in that section, which of the following would be a covered member. So it's just a real simple, which of these is one of the things we just mentioned. So we are Mumbles, that's our accounting firm, doing an audit for Rapid Transit. So who's a covered member who has to follow these rules? What about old Dort here? That's a tax accountant who's now the CEO of Mumbles. CEO is top dog, overseeing things that would fit into that category of someone who can influence the engagement, right? So definitely a covered member. Oh, that's what they're looking for. That's the answer. So that would mean these others are not covered members, and that's usually good to read those just to get a list of examples, at least in your head, of these are not covered members. So this tax manager for our audit firm, they provided 5 hours of tax advisory services to the client. That is not 10 hours, so we're good, right? Kind of gives us a little more insight on what they mean by this 10-hour person. Tingle is an auditor for our company who used to be on the audit team for this client, rotated off 5 years ago and has not had anything to do with this company and is not a partner. So that one's fine, right? Because it is none of these things. It's not on the engagement team, can't influence the engagement, not a partner, none of these other things. So that was fine. And then Saliza, a human resources consultant for our company who provided 5 hours of services. So again, not a 10-hour person, not a partner. These are good questions to kind of slowly read through. 2 is very good. These are things you just kind of have to know. You can't necessarily reason through these. You just kind of have to have the background knowledge on it, have to read the section. We are Curry Audit Firm, auditing Hartsell. We're in Seattle, and they are in Seattle, but we also have a firm in Chicago. Who of the following are covered members? We have to, and again, covered members means they have to follow the independence rules. So Nick answers phones in the Seattle office. That's all Nick does. I think we're cool with Nick, right? Nick is not a covered person. Babe is a tax partner in the Chicago office. Let me reread this. So, right, so C is the answer. Okay, I just had B marked. I'm like, B is not right. And I just wrote it down wrong. And C obviously is, but I'm like, what's the deal? Why did I write B down here? So let me, that's just me messing up on my paper. because I'm like, okay, this guy's a partner, but he's not in the same office. So I was like reading through, are they in Chicago? Does it say they're doing the audit in Chicago? And they're like, no, it says they're both in Seattle. So I'm like, what am I missing here? And I'm like, I think I'm missing the fact that I wrote the answer down wrong. So yeah, this partner is in a different office. And like we said over here, a partner is a covered member, but not a partner in a different office from where the audit team is anchored. So this audit team's in Seattle. This partner in question is in Chicago. So that person does not have to, that person is not a covered member. Nick is not a covered member. And Lou is, because I mean, it's really easy. Lou's on the audit team. So I don't know, I just accidentally wrote B down, but obviously the person on the audit team for this company is definitely a covered member. Just making sure I didn't screw something up by, I don't know, just wrote the wrong answer down. D says Joe is a tax manager in Curry, Seattle office, not a partner, and does no work for the audit client. So Joe's cool. Sorry about that. Sometimes I write something wrong down. Let's jump down to number 6. We'll move along with this one. Got a company here that audits XYZ out of the Boston office. Who among our employees is a covered member? All right, so same type of question. So we got the receptionist. So obviously that's not a covered member. We've got the records guy who lugs around boxes. Bill Wiley author wrote this, so that's fine. Then we got a new college accounting graduate who was added to the audit team. So they're on the audit team. So they are a member of the audit team. Don't let them downplaying their role affect your thinking here. It doesn't matter if they're a new college accounting graduate. They're on the audit team. So yes, they are covered by the independence rules. Okay. So that whole idea of covered members will pop up time and time again in the literature here. So I've gotten to the point where I just replace that with you, because I'm just assuming everything they're talking about is talking about a covered member. So we don't have to be that specific in our notes, right? Got some of the junk out. Network firms and affiliates. So by network firms, they mean firms that cooperate to enhance their capabilities to provide services and share things such as common brand name, control, profits, business strategy, resources, that kind of thing. So here's the rules on that type of situation. They must comply with independent rules with respect to the audit or review clients of the other network firms. That's pretty much in general. They give a little exception there that we're not really ready for, because we don't even know what a review report that's restricted versus unrestricted means. So I just added it in there for the sake of being complete. Basic rule here is if it's a firms in this network cooperative agreement type thing, independence rules apply to the network, right? So you need to be independent of the clients of the other firms in the network for obvious reasons, right? We're all kind of grouped together. That's for audit and review clients. They did make that specific statement there. For other test clients, you can look to the framework to see if you should proceed or not. This is good too. If you get help on an attesting engagement from a firm that is not independent of the client, then you are no longer independent. Good one. And that makes sense, right? So a couple of quick things there. There's really only one question worth looking at here, and that is number 5. That section. Yes. Which of the following is or are true? I thought the other questions were either too easy, and a couple of them were kind of dumb. One of them was just a little too much to fool with. But 5 I thought was a decent question. Simple, but decent. Which of the following is true? If firm A and firm B are in the same network, A must be independent of B's attest clients. If use of the audit or review reports is unrestricted. Well, that sounds pretty good, right? So that's probably it. Look at the others real quick. If firm A and firm B are in the same network, A must be independent of the test. B's attest client if the use of the audit report is restricted. So that goes back to this school thing right here. If the use of the audit report is not restricted, it is unrestricted. So, something we don't really know what that means yet, but we'll get there at some point. C says firms may never use partners or professional employees of other firms on their audit teams, and D says all of these are correct. A is the only one correct. I thought that was the best question of the bunch, and it's not the best because it uses stuff we're not really familiar with yet. So circle back because it's the only one I even halfway liked. Okay. Yeah, because these others are stupid. Like number 2, network firms are firms that cooperate to enhance their capabilities to provide professional services and share which of the following: a parking lot, custodians, stupid questions. It's obviously professional resources. I guess you could think an office building, but 2 totally separate companies that have nothing to do with each other could be in the same office building. So. All right. Reissues, engagement letters, ADR and unpaid fees. Try to remember what they said about an engagement letter. There's a huge section on entirely devoted to engagement letters later on, so we'll hit that a lot harder later. The takeaways from this section to me were really not much. If you're reissuing reports, if you were independent when you first issued an audit report, you may reissue it even if you're no longer independent later on down the road, as long as you don't perform new procedures that would require updating the date. So that's just a oddball off. Kind of a single rule there that doesn't fit anywhere else necessarily. Contractual terms, here's this again. You don't want to have a contract that indemnifies the auditors for their own mistakes. That would not be a good thing. But it is fine to have a contract to indemnify the auditor from problems from the clients making, knowingly misrepresenting things, right? So that's okay. But you don't get to put an indemnification clause on there for your own mistakes, if you can, from the client's knowing misrepresentations. Unpaid fees, you may not sign. This is a really good important thing here. Unpaid fees can be an independence issue if they are unpaid for more than a year. So you may not sign the current year audit report if the client has unpaid fees for services provided more than a year ago. And they're considered unpaid even if we didn't bill them for it. So the whole idea here is at this point, you kind of become a creditor to the client. They owe you for over a year. You got this receivable from them. They owe you money. And obviously, there's going to be a short span of time where they owe you a little money. But if it goes on beyond a year, you're getting into creditor relationship, and that would be an independence problem. If the client's in bankruptcy, then that rule goes away, though. So then that's an exception to that rule. So this is a good test question right here that often likes to show up. Independence problem if they owe you money for over a year on services. So there you go. Let's pass those questions and worth looking at. Financial interest overview and unsolicited financial interest. So just a few more rules here and there. But this one is a big one. So this top one right here, super big. This will show up in a lot of questions in a lot of different ways with a lot of different examples. They'll hit you with these. So all you have to remember is kind of narrow it down to the most simple terms. If you have a direct financial interest in a client, independence is not there. It doesn't matter whether it's material or immaterial. If there's a direct financial interest in that client, you're done. If you have an indirect financial interest in an attest client, then it's impaired only if it's a material indirect. So that's the general rule. This is an overview. We're going to drill into these in a lot more depth in the sections to come. That's the basic rule. Interest, you're done. Material, indirect financial interest, you're done. So for independence to not be impaired, if there's a financial interest involved, it has to be both indirect and immaterial. And we're going to see examples of all of this in the sections to come. And by financial interest, we mean owning equity in the company, debt in the company, derivatives issued by an entity. So a direct financial interest would be something you own directly, even if it's not managed by you, even if it's managed by others. Something under your control, even if it's managed by others. Something owned through an investment vehicle, state, trust, if you control that intermediary or have the ability to participate in the decisions. Again, we'll see lots of test questions to drive these points home a little more clearly. This is just an overview. Indirect financial interest would be something owned through an intermediary, and you don't control the intermediary, and you don't participate in the investment decisions. So that's an overview of the types of things we're going to see in these upcoming sections where the independent stuff really starts to get heavy. Here's a little rule along the way too. If a partner or other professional employee in your firm is not a covered member, so it doesn't fit into that category of all that stuff we said, they still cannot own more than 5% of a client's ownership's interest without impairing independence. So that's just another little, those very specific rules. So all that information about covered members and all the independence rules that they have to follow. Here's a rule for non-covered members. It's like, hey, even you guys, no more than 5% of a client's ownership interest. Otherwise, we're going to hit you with independence impairment. So there is that. And then another little oddball item here. If you, and this is interesting, if you learn that you're about to receive an unsolicited financial interest in a test client, unsolicited means somebody's giving it to you or you're inheriting it. So, here you are on the audit team for this company and suddenly you inherit some stock in that company. It's like, oh no, what do you do? I didn't mean to do this. What am I going to do? So you're not just immediately in trouble or anything. So independence will not be impaired if you are able to dispose of it as soon as it's practicable, hopefully no later than 30 days here, it says. And as long as you don't participate in the engagement, as soon as you learn this is going to happen, and before you dispose. So as soon as you learn it's about to happen, get off the engagement, try to get rid of it, and don't participate in the engagement until it's gone. Of course, I mean, there's other things, you can get off the engagement, quit the firm or whatever too. There's other other options here, but this is the one that would keep you, keep your independence from being impaired, other than quit your job or whatever. Right? I'm sure there's other things too. We got about 10 minutes. Let's look at number 7 and 8 and we'll hit the road. Seven says, a CPA purchased stock in a client corporation and placed it in as an educational fund for our minor child. The trust securities are not material to our wealth, but are material to the child's personal net worth. Would this impair independence with the client? So without even thinking about the rules we just said, just think about in real life if you saw this was the case. Would you think it was a problem? We are CPA. We bought stock in a client corporation and put it in a trust for our kid. It doesn't sound like it's going to fly, does it? And it doesn't. It's a direct financial interest, and it doesn't matter if it's material or not. So there you go. That's pretty easy.
What's the difference between wealth and net worth? Oh, never mind.
Okay. Yeah, not real relevant either anyway. That's the way they wrote the question, basically. Number 8, which of the following would create an independence problem? A says, Sam is on the attest team for client ABC. We're Sam. We don't currently own any of their stock. But we signed a commitment to purchase a small amount, but not until a month after the audit report will issue. That's not something we specifically talked about. But here's the deal with it. Well, what do y'all think? I mean, without even thinking about the rules, does this appear to be a problem? Put yourself in that place. You're auditing ABC. You don't own any of their stock, but here you are on the audit team and you sign off on a commitment to buy some of it, but you're going to wait until the audit report's out.
Yeah, it would be a problem because it got to cool off. It's a cool off period of 1 year after the report. So you got to wait 1 year. So that would be a problem.
Yeah, it's definitely an independence problem. It's a direct interest, and materiality doesn't matter, and their role gaming here doesn't matter either. So that's a problem. But let's keep reading because D says all 3. So let's see if all 3 is the answer or if A is the answer. On B, we are same auditor, same company. We don't currently own any stock in our own name. We're the beneficiary of a trust that holds a lot of it. We do not control the trust investments. All right, so we're once removed from this investment, right? It's Sam, trust, stock. Right? So it's an indirect investment in our client. So materiality is the next question. So this may or may not be material. It depends on whether, it may or may not be an independence problem. It depends on whether it's material or immaterial. So it says we're the beneficiary of a trust that holds a significant amount of stock. So it's material. So this is a problem too because it is material. So indirect, material, that's a problem. A is just materiality, doesn't matter. C, we are not a covered member, okay? But we are a partner in a different office. So we're okay so far. But then look what they put on us at the end there. Uh-oh, we owe 7% of their shares. So we exceed that 5% allowable amount. So I like this question. It gives us 3 good examples. And all 3 of these are an independence problem that senior just hits up on that little special rule that we looked at. I like this. So this is where it starts to get a little more fun. You know, you get to get things like this that you kind of get to reason through. It's not just remembering little tidbits of information. So